Hey everyone, it's Simon here with a quick market update for Tuesday, the 28th of January. I thought it was timely to record a market update video, given we've seen a bit of risk off in markets the last couple of days, and more risk off than we've seen in really a few months actually. Buy the dip has been the dominant strategy that has been working really, really well in the markets for the past few months. So the burning question is, well, we've got a dip now just here. Is this a dip that we can buy? Are we looking at something like this, or is it potentially something more like this? So let's take a look at the evidence and see what sort of an answer we can come up with. So just looking at the chart in front of us, this is a chart of the S&P 500. It was down almost 1.6% last night. Any move in a major stock market index of more than 1% is a move with conviction. And of course, the reason for the selling that we're seeing is the spread of the coronavirus, which has really been dominating media headlines for the last 3 or 4 days. What the market is trying to wrestle with or discount at the moment is the likely impact that this virus could have on the world economy. Now, we already know that the Chinese government have extended the Chinese New Year holiday this year. The Chinese stock market and Chinese businesses were due to reopen this Friday, 31st of January. The holiday's been extended to the following Monday, the 3rd of February. We also know that the Suzhou manufacturing precinct is going to stay shuttered until the 8th of February in an attempt to reduce the spread of the outbreak. Okay, so straight away you can see that manufacturing is going to take a small hit. But to the extent that people are kind of barricading themselves up at home, it could impact consumer spending, it's going to impact travel, the movement of people, and all of these things, if they're impacted by the virus, will have a knock-on effect to global economic growth. Now, if the impact's only for a few days or a few weeks, it's probably no big deal. But if this virus does become, if the World Health Organization declares it a global pandemic and people really start to, I guess, radically alter their behaviors as a result of that, it really could have a knock-on effect to global growth. And I've got zero edge in trying to predict the likelihood of that. So I'm just going to stick with what I know, which is markets and internals and technical analysis. Now, importantly, the virus is likely to take a backseat to both earnings and the Federal Reserve this week. Okay, we're in earnings season, and this is the week where earnings season really swings into full gear. If we have a quick look at the earnings calendar, you can see that it's a very, very busy week. We've got Apple tonight, all right, largest market cap stock in the US stock market, but it's not just Apple. We've got Microsoft, we've got Facebook, we've got Amazon. So there's 4 of the 6 MAFANG stocks. We already had Netflix last week. Their result was pretty good, and we got Google next week. All right, so some real heavy hitting stocks coming up with earnings. We have also got a bunch of other important stocks reporting. If we look at before market today, we've got 3M, Pfizer, United Technologies, we've got SAP, Xerox, Pulte Group. After market, we've got AMD, Starbucks, Xilinx, eBay. Tomorrow before market, we got Boeing, GE, AT&T, McDonald's, Progressive Enterprises, Anthem. In addition to Microsoft and Facebook, we've got Tesla, PayPal, Lam Research, ServiceNow, Align Technologies, Las Vegas Sands. I'm recording this from Singapore. Thursday, we got Coca-Cola, UPS, Verizon. We got Blackstone. After market, we got Amazon, as I mentioned, Visa, Western Digital, EA, Amgen, and then Friday we got the big oil stocks, Chevron and Exxon. We got Caterpillar, Honeywell, Charter Communications. So really big week for earnings. And if these stocks can come up with earnings beats and upgrades to guidance, that will give the market a much needed shot in the arm. Obviously, if they don't, if earnings or guidance disappoint, that could cause another leg down in markets. But I don't want to be aggressively short the market here ahead of things like Apple earnings after market today. Okay, so earnings really important. The other thing really important happening this week is the FOMC meeting. Okay, so the Fed are meeting and they will announce the press conference on Wednesday during market hours. No change to interest rates are expected, but I don't think it's very likely the Fed are going to say anything that will ruffle the market's feathers, given the extent of the sell-off that we've seen so far. I think that they will, if anything, present a fairly soothing tone to the markets. They'll talk about how they're going to continue to provide liquidity to the repo market and remain flexible in their policy and these types of things. I think they're only going to say what the market wants to hear. And again, some soothing comments from the Fed could see the market find some footing here. So I've got a couple of potential short-term positives in the Fed and earnings. If they both go the right way, they could see markets rally from here. The other thing that could be deemed as a short-term positive is the fact that markets have been reverted. If we just have a look at this chart here, you can see that usually when the market gets to this upper band, it'll pull back to this purple band in the middle. Sometimes it goes beyond that. But usually what happens, sometimes we don't even need to get to the top red band. But usually when we get up here, we do get a pullback. Now that purple band in the middle is the mean. It's approximately the average. And in an uptrend, the market will spend most of its time above the mean, right? But it will come back and kiss the mean every now and then. And that is what it's done, okay? So you could argue that mean reversion has occurred. That's all we're going to get in terms of the extent of the pullback. And if we look at what S&P 500 futures are doing right now, you can see on this chart here that they're up 71 basis points. So S&P 500 futures have rallied, even though the S&P closed pretty close to its lows for the session last night, the futures have continued to rally, which also lends weight to the idea that equities could bounce from these levels. So is this the dip that we've been waiting for, and is this the dip that we should buy? And I would say not so fast. Okay, I would like to see markets pull back a little bit further, and I would like to see a couple of other developments happen before I got a bit more confident on increasing my long exposure to equities here. Okay, the main thing that makes me a little bit cautious still is the put-call ratio. So here is a chart of the put-call ratio, and this white line is the 10-day moving average of the put-call ratio. What the put-call ratio does is it tells us how many market participants are seeking long exposure to the market by buying call options versus short exposure or hedging exposure by buying put options. Now, when the 10-day moving average of the put-call ratio drops below 0.8, that is a good indication that kind of everybody's long, the market's complacent. And when the market gets too complacent and everyone's long, that usually coincides with a top. Not precisely, but it puts you on notice that a pullback becomes more likely. And if we have a look, you can see when we get below 0.8 here, it generally coincides with a top. It's not a precise timing tool, but it is a useful heads up. Now this period here has been a little unusual. Not unprecedented, but certainly unusual, and that we've been extended for a long period of time, which is why the stock market has felt the price action that we've seen has felt a bit like a melt up. It's not really a melt up in the context of what happened to the NASDAQ in 1999, where it put on 90% in 6 months. We're nowhere near that sort of territory, but certainly even the slightest dip has been aggressively bought. But now that we've got something that is causing the markets a little bit more uncertainty, and I'm talking about this coronavirus, we're in a situation where the market is long and we potentially don't have too many buyers yet. The market is probably going to need to work off some of this long exposure before we get more people to. And so I want to see this 10-day moving average of the put-call ratio normalize and head back up into this sort of range before becoming more confident on a sort of medium-term floor for the stock market. The other thing we need to be aware of is of course, sentiment, because it really is sentiment that drives short-term market prices. And if we have a look at the CNN Fear and Greed Index, this has spent the better part of the last 6 weeks in extreme greed mode. You can see we were in extreme greed a month ago. It's really been up here since mid-December. We're now back at neutral. Okay, so we're no longer in extreme greed, but given the amount of time we spent in extreme greed, I think we probably need to come back to extreme fear, or at least fear, to work off some of that over-exuberant sentiment. And the only way that's going to happen is if we see lower equity prices. So how much lower could we go? Well, let's have a look at the last couple of pullbacks that we've seen on the S&P to get an idea of that. So if we look at the most recent pullback in December, which frankly was tiny, and it only lasted for 3 days, we've already exceeded that. Now, if we took a 1.618 extension of this pullback, that would take us to, say, 3,200 on the S&P. Now, if we look at the last kind of proper correction, which was still pretty small, really, this is the one we had back in September, October last year, you can see that if we run that up to the all-time high, we're kind of targeting, if this correction that we're currently in doesn't finish until it was the same size as that one, we're kind of targeting 3175 on the S&P. So 3175 to 3200 looks like a pretty good target to me, and if we got down there, we'd probably see things like the put-call ratio normalize. And who knows, maybe even get back into bullish territory. The other thing to bear in mind is if we go back to this chart here, when the S&P does have a quote unquote proper pullback, it very often does make that bottom band. And if we were to make the bottom band here, you can see, and let me just zoom in on that chart a little bit, we would in fact get to this 3175 to 3200 kind of range. So that to me it looks like a pretty good downside target for the S&P. It's only another, call it 60 points, 70 points away from where we are. So not the end of the world by any stretch. But it does leave me feeling as though if I'm going to play the long side of the market, I'm going to wait for some deeper pullbacks. B, I really want to be focused on some stocks with some specific catalysts. So stocks with earnings coming up, for example, or maybe stocks with high short interest. Tesla has been the poster child for that lately. My best guess from here on out is that we get a short-term bounce in the market. Maybe we fill that gap, and then we get another leg down into this sort of territory. And at this point, if we get to sort of 3,200 or the high 3,100s, that would be the sort of target I'd be looking for to maybe step up my long exposure to the market. My current asset allocation in my trading account, I'm about 25% long. I'm about 15% short and about 60% cash. And I won't really be looking to put much more of that cash to work until we get, I think, a more meaningful pullback. Another important thing to keep an eye on here is dollar yen. Dollar yen is a really good barometer of risk. Now, yen is regarded as a safe haven, a flight to safety type of asset. So when market participants are fleeing risk and seeking safety, dollar yen will fall because yen is being bid up. So dollar weakens versus the yen. Now, we have seen dollar yen weaken, but it hasn't completely collapsed. Okay, it hasn't taken out this low, hasn't even got back to its 200-day moving average. So the fact that dollar yen hasn't collapsed, I think also lends credibility to the idea that equities could have a short-term rally here. But I'm not really interested in playing that because honestly, it could only go for 2 or 3 or 4 days. But if dollar yen actually does find a footing here and starts to rally, I may need to reassess and at that point become a little bit more bullish on equities than I am. Dollar yen is not in a very strong trend here, but it's certainly it's certainly closer to an uptrend than a downtrend. Okay, and if dollar yen is in an uptrend, that's not something you would expect to see immediately prior to a big market top. Other things you don't tend to see before big market tops are record highs in semiconductors. Now, semiconductors bore the brunt of the selling last night because it is a very high beta sector of the market, but they were at the previous session they were at all-time highs. Home builders are also at all-time highs, or just shy of it. They actually held up pretty well last night. But home builders, semiconductors, two sectors that are very high beta sectors of the equity market. And they would tend to be the canaries in the coal mine. They would not normally be at all-time highs if markets were at the precipice of a very major decline. Other things I do have some long exposure to, defensive longs such as TLT. TLT is the ETF that tracks the sort of long end of the US Treasury market. That's had a really good run of late. I wouldn't be adding to that here. In fact, I did take part profits last night because it's looking overextended. You can see here it's a long way away from its mean. But TLT in weakness I think is attractive. Things like gold as well. Bonds and gold both tend to perform quite well when equity markets are feeling more nervous. So they can be good things to have exposure to. Like I said, I wouldn't run out and buy them now, but having some exposure to them as a little bit of a hedge, I think is a good idea. So in conclusion, I'm not super bearish on the markets, although I will revise that if headlines on the coronavirus continue to worsen and if the World Health Organization does declare it a global pandemic, certainly things I think for equities could start to look a lot worse. But unless or until that happens, I think we await a slightly bigger dip, and that could be a good opportunity to increase long exposure to equities. I hope it helps, and if you've got any questions or comments, please leave them in the comments section below. Thank you.